Hello and welcome back to Bar Snacks. Today I'm going to be talking about the money supply, how governments control the money supply, and its effects on inflation and interest rates. So in GCSE economics, we considered the relationship between money supply and inflation. And this is quite an intuitive relationship because when you think about cases of hyperinflation, it was often because the money supply was increased far too much. Basically, what happens is increasing the money supply encourages consumption and investment, which are components of aggregate demand, which is consumption plus investment plus government spending plus net exports. And because those are constituents of aggregate demand is bound to increase. Because of how we think about economic theories, we tend to think about ceteris paribus, which means all other things being equal, which means our GDP growth, our output, did not increase. And what you have here is a shift in the equilibrium from this point to this point. So if I draw the lines across, let's think about our definition of inflation, a general and sustained increase in the price of goods. Here is the price level. You can see that thanks to increasing the money supply, increasing aggregate demand, we've seen a general rise in the price levels. And because the famous cases, such as Zimbabwe in 2008, have happened like this is a very intuitive relationship, and this is how we were introduced to money supply. But a more interesting relationship is between money supply, inflation rates, and interest rates all combined. So I'm going to introduce this new graph down here. It looks very much like the old one, but we have different parameters. And this is the money market graph. So we have the supply of money, which is at a consistent point. It's perfectly inelastic because the government controls the supply of money and there's no way of altering it. Well, there is a way of altering the quantity, but at any quantity it's perfectly inelastic because they've decided that's how much money there is. There's not going to be any more or any less, and it's entirely regulated by the government that way. So it's perfectly inelastic. Here we have the nominal interest rate. Here we have the quantity of money. And this is the demand for money. So the demand for loans, essentially. And as we can see, as the net interest rate rises, people want to loan less because it costs more and they want to save more. So there's less demand for money when interest rates get high, and when interest rates are low, there's more demand for money. And you can clearly see that shifting the money supply, either constricting it or expanding it, has an effect on the interest rate. So restricting it increases interest rates. That means it discourages loans and encourages saving, and increasing it lowers the interest rate, which means it encourages loans and discourages savings. But how do governments actually make this process happen to control interest rates? How do the governments alter the money supply? And there's a few different ways they do it. Point one is reserve requirements. This is the amount of money that commercial banks have to hold at central banks with how much they lend out. So banks lending out a huge amount in loans have to keep more money at the central bank. It's usually a ratio like that. I'm going to make an example here to illustrate how reserve requirements work. Let's say there's a 10-to-1 ratio. So for every £10 a bank loans out, they have to keep £1 in reserve at the central bank. That means if they loan out £100 in total, right? They loan out £100 in total, they have to keep £10 in reserve. So they have a total of £110 in cash, but they can only loan out 100. But if we change the reserve requirement to 10.05, they have the same amount of total assets, but they only have to keep £5 in reserve, so they can loan out £105. This means there's more money into the economy, which means we've expanded the supply of money and subsequently lowered the interest rate. Point two is the bank rate. This is the rate at which commercial banks must pay interest if they borrow from the central bank. Now, this happens quite a lot when banks need liquidity, so they borrow from the central bank. And if there's a lower interest rate on that loan, what that means is that banks are more inclined to take out loans and have money which they can then lend out to more people. So let's say you raise the bank rate. This means that banks are less inclined to borrow from the central bank and thus have less money to loan out. So what you've done is contracted the supply of money, which has increased interest rates. Number 3 is quantitative easing. This is quite a famous method because it's been used a lot recently. The Eurozone is almost done with their quantitative easing program, but it's essentially governments buying corporate bonds to inject money into the economy. So they buy corporate bonds, companies receive the cash, and that increases money. So this quantitative easing is always an increase in the money supply. That's what the easing means, is an increase in the money supply. So this is how banks mainly alter the money supply. In the UK, we don't have reserve requirements, so it's mainly bank rates since we don't do quantitative easing anymore. Let's consider the bigger effects that this has on interest rates and inflation rates. So let's say you increase the supply of money. Let's check back with our diagram. If you increase the supply of money, then naturally you're going to have lower interest rates according to the market mechanism in the money market. Lower interest rates encourage people to take out loans. So that means that people are more likely to consume and invest. This means there's a subsequent increase in aggregate demand, which we saw in our first diagram, an increase. Now, if there's no economic growth, which there shouldn't be, because consumption and investment encourages output to expand and thus GDP to expand, or if the shift in the long run aggregate supply curve is only minimal, that would give us a new equilibrium here. If the shift is only minimal, that means that inflation will happen. So if the supply of money grows more than the output, then inflation will occur. But it's all about how much the output is able to shift. And here we can now document the interesting relationship between these three things. The change in the supply of money inversely affects the interest rate, but affects the potential for inflation in the same way. I just thought this was really cool. We learnt it in class the other day, and I thought it was really interesting and worth sharing some insight with you. Thank you. I've been Barsnax. See you next time.